Hello everyone. Now this next IFS talk could be crucial if you're to stay ahead in the market. Liquidity dynamics, redefining strategies for success. So if you could give a warm welcome to our moderator, Mr. Hormoz Faryar, who's the Managing Director Dubai at ATFX Connect, who will introduce his panel. Hormoz, the floor is yours.
Thank you so much. Hi everyone, so we got a panel on FX liquidity today, and my name is Hormoz Faryar from ATFX Connect. I'm based here in Dubai, and I want to just briefly get everyone to introduce themselves, and then we'll start with the first question. Sam, if we start with you, please.
Thank you, Hormoz. I'm Sam Johnson. I just joined ISAM Securities as Managing Director.
Hello everyone, this is Mohammed Yunus from Noor Clearing.
John Murillo, Chief Dealing Officer at B2 Broker. We're a liquidity and technology provider.
Mohammed Spear, Global Head of Brokerage Sales at Equity Group. We're also in the liquidity business and we do retail business on the side as well.
Great, so I want to start with the first question, and that is about just generally a little summary about 2023 and what was the highlight of the year perhaps. And I think gold's going to be in there probably, and also sort of what the gold dynamics that changed during that year, perhaps. Perhaps I start with you, Isbir.
So, one of the main highlights was, for me, it's the gold volatility, while there was a lack of volatility across all other asset classes. And from a liquidity perspective, there was a big gap between supply and demand. And if I want to maybe summarize that in a little bit. So I think it started during COVID when there was a shortage of supply and there was the mining stopped and the shipping stopped for a while. So that created a bit of a gap between the spot and the future. And then recently with the exit of Credit Suisse from the space, that was a major factor because Credit Suisse was one of the biggest kind of liquidity providers in gold. That absence has not been replaced and it has created a big gap. At the same time, you've got, because gold is the only volatile instrument on the screen, so the demand is there. The demand is actually increasing day by day, which created that gap between the supply and demand. Now, the problem is you got three layers, and you got the end client who wants to do big clips of gold. You got the retail broker who's creating sometimes a synthetic liquidity, which gives the client that illusion that liquidity is still the same, and then you have the actual underlying market where the liquidity on gold is not as it used to be before. So for me, that gap it became very obvious in 2023, and steps needs to be taken to kind of remedy that gap. And I think for me, the main thing, it should start maybe with retail brokers trying to act as much as possible, mimic the actual underlying liquidity in the market, and I know there's thousands of retail brokers. I'm not talking about the small ones. We're talking about the big ones that have reputation, that have a big market share. We need to start educating end clients that the gold liquidity has changed. There's new rules of engagement, and then they will understand when all the market kind of comes together, and then there's alignment across all these levels.
Yeah, John. Just anything to add on the 2023 and the liquidity mirage, as it's called, right? Where you can create liquidity mirage looking like there is a lot of liquidity in some markets, but there isn't when you dig deeper.
Yeah, I think, as we all know, 23 was in particular for gold trading purposes, a year where there was not a whole lot of volatility during the first 3 quarters. Then we had a geopolitical event that changed the landscape. What I think there's a lack of understanding to some degree by many participants is that UBS taking over the business of Credit Suisse, or Credit Suisse exiting the gold market making space, created a new pricing model that it is reflecting new conditions. However, and we've seen this specifically through our client base, they were very unprepared to this new norm, to these new conditions that basically a major tier 1 bank exiting has triggered. And repricing accordingly was a hell of an adjustment for many participants. As a matter of fact, we received a lot of feedback from clients. They couldn't comprehend why we were seeing wider pricing. I think a lot, and I've said this in other panels, historically, it's about businesses like ours educating our partners or our clients in order to convey that message to their end users. Catering to clients just for the sake of satisfying their needs is not the way to grow a business. It is a way to attract business, but just like anything, we have to adapt to the times in which we're in. Liquidity construction is something that requires a great deal of analytics and understanding of how to market, how to create a price, how to distribute that price, and ensure, and I think we will touch base on this, latency is a key component. So it was a transition year, but from our side, I think last quarter on gold was tremendously volatile and volumes were pretty decent.
Yeah, Mohammed, anything to add on 2023 for you guys? Maybe slightly different in Middle East or?
Now, in general, 2023 was a very interesting year in the whole sector of brokerage. And in this part of the Middle East, UAE and Dubai had a big part of it. We saw the numbers in 2023. I think it was related to what happened in COVID and how UAE handled the COVID situation. We had the least number of lockdown days, and the airports, the import-export didn't stop. So this attracted a lot of business to this area. A lot of relating to the gold, a lot of gold business stopped going to Europe or to US and start coming here. Now, in general, in this 3 years after the COVID, a lot of people tried to come here and establish. A lot of LBs, prime brokers, also started. I remember beginning of this year, in the ESCA, we were like 5 companies, prime brokers, trying to get the license or got the license. Now we're seeing more than 25 in the different categories of ESCA. This is showing in numbers. Now, the physical gold also, because most of the refineries are bringing the business here, we are seeing a lot of people trying to hedge their positions, which increase the volumes for the liquidities, and also the spread matters. Also, it's a big challenge for us. I think we're going to come to 2024 with bigger numbers. I think Dubai, Middle East, always have a big impact on these things. I think it's going to be a very promising year as well.
Yeah. Sam, you're an ex-UBS, I'm an ex-Credit Suisse. They're blaming UBS and Credit Suisse for some of these problems with gold. So what's your thoughts on this now?
Well, in respect to my previous employer, I don't think they were minnows in metals. I think they're pretty good. I actually kind of thought from an institutional side, the market did an okay job over perhaps a protracted period, to be fair, John, of kind of absorbing it. I think what was strange is clearly the gold trade was a big play by retail on a lot of interest rate moves over last year, and I think that's where a lot of people played it, certainly on the dollar side. And then I think we saw the sort of classic clear out when we saw that spike up to the new highs back in the last quarter. I think the bit for me that's been kind of interesting actually is recently and towards the end of last year, there's another example of the market, particularly in the retail space, not really pricing risk very well. So even after some annualized volatility rates at around 20%, which is significant and certainly well in elevation of anything in the majors, we're now seeing single-digit top of books in golds, and we've heard fixed spreads here and this, that, and the other, and that just isn't durable. So it's strange to hear that, and I think, again, one of the things we're going to touch on is it's not reflective of the risk, it's reflective of how certain liquidity providers are reacting to a competitive environment, as they should, but perhaps pursuing revenues through other means. And I think the fact that those are more opaque kind of compels a lot of the industry to take another look at itself and see really, how do we make sure that pricing's fair across the board, whether that's spreads, comms, swaps, or whatever.
Yeah, so in your opinion, 2023 summary, this is the story from a liquidity perspective, gold and Credit Suisse exiting and the Gaza issue causing this. this gold move, that's the biggest liquidity story of 2023 in your opinion?
Well, I think that was probably the biggest story of the second half. I think we still, the big one in terms of capital flow is still the inflationary story, the global monetary policy readjustment. I still think in terms of capital flow, that's the one that plays out all the time. That's what it comes back to. But certainly those geopolitical events, those market microstructure events from last year played into that. I think they exacerbated a thin liquidity environment.
Yeah, I feel like maybe this year we might have some volatility with election and Trump coming back perhaps and all that. So we might see some big stuff this year as well.
I mean, this is what we're all looking for, aren't we? I mean, we need that volatility back. And I think the other factor is hopefully maybe start to kind of lowering interest rates. That's going to create another kind of wave of new influx of investments into the space. Because I think a big part of that lower volatility we had in the last 2 years was part of it, higher interest rates and investments are going into fixed income and stuff like that. So hopefully also within the next 6 months, the Fed has already started to kind of hint to lower the rates. I think that will also bring back some of the volatility back in the market.
Yeah. Anything to add before I move on to this segue into the next question, which is cost of liquidity. I want to hear a little bit about cost of liquidity in terms of swaps, spreads, etc. Maybe Sam, what's your thoughts on cost of liquidity and how it should be described, perhaps, or?
Yeah, I think it's a good example of, it's a multifaceted industry and multifaceted products, and because of that, you need to have the team and the tools to make sure you're paying correctly for those things and that you're able to survive some of those micro trends over the long term and not upset your own client business. So, as I kind of referred to in the previous question, I think we've seen some strange interplays between different, I suppose you could call them revenue streams for LPs. And I think some of those have very high transparency in the case of spreads or arguably comms. And then there are other parts of the business model that don't. And I think swaps are probably one of those things that over the next 12, 24 months, I think the industry's probably got to move to a place where that's a fairer landscape. And the cost of liquidity is treated holistically, not in the individual lines.
Yeah.
If I might as well, I think also the spectrum of the things that we should look at when we look at the cost of liquidity should kind of extend to more than that. Because for me, I've been having questions even in this expo when someone comes to me, especially startup brokers, and they say, okay, you gave me your metrics. When I go to other brokers, because they want to see everyone, what should I ask for? So for me, you got the cost of liquidity comes on spread, commission, swaps, but also extends to credit, margin. Because the way we look at it from a liquidity perspective is my return on investment on the credit as well that I'm investing in this client. So if I'm offering you a higher leverage, it's okay for me, or if I'm giving you a credit facility, if I'm, any of capital that I use to kind of clear your trades, I need to be earning a certain amount, a threshold of revenue on that. So if I'm offering a higher margin, that means it's okay for me to kind of charge you a slightly wider spread. It's a metrics that we look at maybe across 5 or 6 different things. It's completely unfair, in my opinion, that we just look at the spread. Quality of execution, order book size, all of that really matters. But the race to the bottom on spread is really annoying, and it kind of creates fake, everybody is just trying to kind of aggregate pre-aggregated feeds, which leads to lower spread, but when it comes to execution and double hitting, and creates all sorts of problems. So yeah, I think there's 5 or 6 different things that we need to look at when we look at the cost of liquidity.
Yeah, John, what's your thoughts on cost of liquidity there? Because, I have some views on this because, so for me, it's a matter of perhaps protecting the company to such an extent. So at ATFX, we look at it as you protect your company, which means you protect your clients at the end of the day. So you have to be really careful with what you provide out there.
Well, definitely. I mean, look, cost of liquidity will always come down to what you just mentioned, Mohammed. You're utilizing your balance sheet to facilitate a service and ultimately there has to be a return on investment. Now, in a great way, I think it comes down to how much volume you're processing, which means your cost of doing business will always be much less than if you don't have any flow going through. And banks primarily, or LPs, were priced according to the volume and the value of that relationship. If we combine these elements, the cost of liquidity in reality can be quite dynamic based on your business cycle. The customer that is giving you 50 yards of business a month has a certain value to any organization, especially us here, versus the guy who sends you 500 million in a month. So that cost, I think, will be dictated, once again, by volume processed. It's just that, cost of doing business is always going to be less if you process a significant amount.
Makes sense.
Well, what I think, this year I had a lot of discussions with people. They're thinking that 2024 the cost will go down or will go back to what it was before. We need to take in consideration, yes, there's U.S. elections, and also there's different 40 other elections worldwide. There's 40 countries going to have elections this year. So there's a big change also in the political grounds. I think this will going to have a big impact in the economies. It's going to have more uncertainty and securities. So I think it might not be a clever call to go for and gain profits this year. No, I think we should be in a safe zone a little bit, to take down the risk appetite. Cost liquidity should be a bit higher just to keep things going, as it is. We don't want to risk going the other way.
Makes me think, if you look at the last few years, I haven't run the numbers, but I would assume, everyone assumes that the average spreads are just going lower every year, for example. And the question is, would there be a year like this where we have so many elections and so many things might happen that the average spreads of the major currencies and gold might be higher than the last couple of years? I wonder if anyone knows the numbers. I don't know, Sam, has there been years where average spreads just have gone up, or is it just a race to the bottom, pretty straight line over the last 10 years?
I think post-COVID we saw a rewriting of liquidity costs, and some really long-standing microstructures were completely destroyed. Mohammed, you mentioned gold and EFPs earlier. We saw oil go negative on the futures. Gold EFPs went from 10 cents to $50. So a lot of cheaper, lower quality liquidity provision in the marketplace that became heavily overbroked, especially as it was cheap to provide, it was cheap to invest. The cost of capital was very small. I think a lot of that got carried out. And from memory, and I haven't done the data on the majors, but there was a long tail for that liquidity getting better, and I don't think we're pre-COVID on that yet. And that's why I say, some of the products that we do see this crazy race to the bottom is not representative of the underlying institutional structure and what's there, and that's kind of alarming, and especially as we go into what's a very heavily geopolitically volatile period where we're going to have significant gap risk. I think we're going to be facing the same problem, and especially now when, certainly for the retail broker and the retail clients on the other side, where they're expecting a certain spread, a certain volatility, that may become as a bit of a shock when that changes. And I think we're going to have lots of opportunities for that this year. And hopefully that means flow for us, that's our lifeblood. But if it's high volatility, low volume, that's not really going to help anybody.
I like that. That basically means to all my clients out there, we might have to increase your commissions this year because things are going to get more expensive. It's not always cheaper every year. Is that right?
So also the way I see it, it's usually after a major event, usually, spreads would generally go up. So we saw that in the last maybe 10 years. We saw that after SMB, and then we saw it after COVID. And then after that, things start to normalize, and then the race to the bottom kind of starts again. And then you have another, the flash crash after. So in my opinion, it wouldn't be this year maybe where we're going to see an increase in spread, but for me, it's not kind of like a cycle. It's whenever there's a major event. Because I remember in Hormuz, you and me were used to work together at that time. SMB, after that, we saw an increase in spread for the next 2-3 months, and then everything started to kind of calm down. And then oil, when it went negative, flash crash, all of these events resulted in higher spreads, and then everybody starts racing to the bottom. And the problem, I think, with racing to the bottom is not only because the underlying liquidity or the underlying actual markets and the bank liquidity might not be that aggressive, but creating a lot of synthetic liquidity in the market does that. B-book liquidity, synthetic liquidity. This is where the race to the bottom starts, and then everybody else has to follow. And then, like one of the topics we're going to discuss later, I know that's aggregation, and
this actually feeds into that because I guess maybe if someone expects less and less spreads, they would expect maybe let's aggregate, and let's aggregate a lot of providers. The more providers we aggregate, the less spreads we're going to get. Sam, what's your view on aggregation and what's the purpose? What are people trying to achieve? So you aggregate, some people will aggregate, 20 different providers and try and get the spread down. That's not a great idea, is it?
Yeah, I mean, the institutional kind of space has spent probably the last decade on trying to get this right. I mean, ultimately, aggregation works for you in spread compression so long as your liquidity provider is differentiated. So do they have something unique about their inventory or their pricing that when you put that in with other liquidity providers, altogether that works in harmony for your business? Where it doesn't work is if the quality of those LPs is low or the business model is a facsimile of anything else you've got in, because the addition in terms of the advantage to your spread compression isn't there if it's the same. That's the thing that should be fairly intuitive. And if you've got low quality LPs, and this is again why if you're going to aggregate, and that does make sense, I totally understand that, but you do have to make sure that you're testing the quality of your LPs. So there's, as you said, there's almost a bell curve for what that number is, and I think that depends on what you're trying to look for and which LPs you've got in there. 20 is probably the wrong answer. 3 is also wrong.
7. I did the research years ago.
7 or 8 is probably
7.
about right. But they've got to be 7 or 8 good ones, I think.
7 LPs. John, thoughts on number of LPs? You aggregate 100?
Not yet. No. We are very selective on our relationships. And I think what it comes down to, though, when you aggregate, unless you have that tech that gives you that edge, unless you are able to have that discussion with your bank, with your partner, what is it that you're trying to achieve? Remember, retail liquidity doesn't suit all businesses. There's some pretty sharp institutional business out there that needs to be handled slightly different. If you don't convey that message to your partner, they get caught by surprise. There will be some inefficient fill rates. Or on the other side, we see a lot of this even with our own solution on copy trading that we sell to our customers on the tech side of the business. And a lot of times, clients, because they're using MT4, slightly, aged tech, they may spray us with 1,000 orders within a second or two. When this order gets sent out to the LP, well, basically, unless they understand that tag, that end user, that is copy trading flow, they may think it's 1,000 different orders coming in from 1,000 different clients. So we've seen over the years that you gotta have that dialogue, otherwise aggregation doesn't work. Liquidity discussions are vital to have a healthy relationship in an ideal execution, in non-ideal world.
Makes sense.
So if I also jump in, so aggregation for me is two different levels. Yeah. So as a prime of prime service provider, so for me when I aggregate the banks, 6 or 7 is probably the right the magic number to kind of create a nice liquidity pool. It's nice also to have your own pricing, which kind of skews in the right direction, which improves on the aggregation side and kind of gives you that edge to take the flow that you want. My biggest problem is as a prime of prime service provider, and then when I sell my liquidity to the retail broker, is then they will aggregate my pre-aggregated pool with, let's say, ATFs. ATFX is a pre-aggregated pool. And then they're trying to race to the bottom, and they're trying to kind of achieve the best possible spread by aggregating pre-aggregated pool, which already has the same you
can't
underlying
juice
LPs.
any more out of that.
Yeah,
They're trying to juice too much out of what's not
yeah,
there.
so you're trying to reduce too much, but you're creating a bigger problem for yourself, for your LPs, even for the prime of prime, because I cannot make as much money of that. I definitely prefer to kind of, I'm giving you an already pre-aggregated pool. I need to make money, so I need to see both sides of the trades. And you're pissing off the underlying LPs, the banks on the back of that, because it creates fake latency, it creates double hitting. So for me, prime of primes aggregating bank and tier 1 liquidity, that's okay, and there's a magic number, and it's good to have your own pricing. But for retail brokers to aggregate pre-aggregated fees, this is where the problem lies.
Yeah, aggregating the aggregators.
Yeah.
Yes, no, the guys said it all, but mainly I think there's more awareness from the prime brokers that it's not only about aggregating for get better pricing. When you get your lines of liquidity stable, that's also costing money. That's saving money actually, not only just aggregating. So I think when you have a stable lines, you don't need to aggregate because your clients have the awareness now that we need a stable liquidity lines, that we don't need to change it every time and then. They will feel it, So I think, and as Spear said, that we are pissing off the banks, the LPs. And this, for how long is going to continue? At some point, they're going to feel it. And this aggregation will be harder and harder.
Okay, great. I'm going to jump on to my next question. I've written down here so I don't forget. This one's interesting because I want to talk about sort of slow response time. So when a client connects and wants to trade, there is this idea in the market where people slow down response times so that it's artificially perhaps protecting the company against bad actors. But in my opinion, can it harm the good clients then? If you take certain actions across the board, how do you? So Sam, explain for the audience, how would you protect yourself while not punishing, let's say, good clients? How do you? Or is it not possible? Because you might have bad actors, you will punish good clients as well, and good clients are maybe paying for it out there because of the protection we might provide because of bad actors.
Yeah, I think, so again, I think we're touching on additional hold time as part of last look there. That was certainly advertised as being a protection measure against bad actors, against LPs. But I think it was pretty clear and it's well established by some of the sort of tier ones and big non-bank market makers out there over the last few years that it was abused. It was used to artificially provide tight spreads and then capture a more profitable pool of the trades by increasing reject rates. And when you boil that down to its constituent parts, you can either reject clients more or you can just have a better, faster price. And I think it's demonstrative that everybody in the institutional spaces accept that. It's one of the core tenets of the global code. And ultimately, the best thing an LP can do to address the concerns of bad actors that they have with their own LP stack is to invest in their technology, be fast, be correct, and if you still have a problem, you should adjust the price. I think that's well established, and I do think that's something that in the retail space, that's coming sooner or later. I think the problem in the retail space is it's a much more diversified market in terms of tech, and I'm not sure the tech is there and the understanding is there just yet in order to address it in the same way as the institutional space is done at the moment.
John, thoughts on the hold times, last look?
Yeah, this is
unfair behavior.
a topic that is always been controversial. Our view on this in particular is it goes to the actual level of expertise that your partner has and understanding of how liquidity works, why was it created, what is the actual purpose. You don't want to punish all your clients because you got a couple of guys, trying to hurt the business. Can you find that perfect balance on a timely manner? I will be the one to say no. It takes a little bit of time to pick up for the LPs to see that tag and say, I don't like that end user. We need to do something about it. Again, if a partner can communicate that to their LP, there is a very strong possibility that you will not hurt the rest of your book. It will only be a minimum impact. But again, I think there was a reason why it was created. I think it's not necessarily a negative. It is just how it's used. And if you have the understanding of it, if you have the tech stack to be able to assess it on a timely manner once again, then you will probably be quite successful with it, rather. But again, this is education. We focus a lot on educating our partners, our brokers, of how liquidity actually works. So when those situations arise, they even know how to handle the clients themselves. It's more of a proactive approach.
You know, we have a relatively big liquidity management team in London to be close to the liquidity providers, the banks in London. And of course, I think I agree with this, that if your liquidity... So I've seen the cases where you provide, you take a client feed, give it to certain type of banks, and it's difficult for one bank in London, but then another bank in the US can price the same client and be completely happy with it, which is quite interesting. You might say, well, this was a challenging flow maybe for this bank, but it's not for another bank, which is quite interesting, which makes the whole liquidity management world so complicated and so complex and so interesting, where you remove certain type of liquidity, and it's not necessarily, a lot of people might jump into conclusion and say, this is toxic flow. It's not. The other guy loves this flow. Yeah. And that's quite interesting.
If I want to jump in, I think, John, it was you who said, protecting the broker as well is one of the first steps to protecting the client as well. So I'm definitely pro having that, like you said, it was created for a reason. It's not just, and to be honest, maybe the normal, I would say, a normal client today is not the same definition of a normal client maybe 5 years ago. So the flow in the market is becoming tougher and tougher. Brokers have been run down in the last 5 years, and it's becoming more challenging. So I think the right balance is important. Use it but not abuse it. I think it needs to be there. It's a level of protection that needs to be there, because again, if we don't protect the broker, we're not protecting the client. So I think it needs to be there as a level of protection. How do you use it? That defines if you're being fair or unfair to your client. If you abuse it, if you, it's not one size fits all. If you're painting everyone with the same brush, that's a problem. But if you know how to use it, I mean, the systems are becoming smarter and smarter. There's tags. There's a lot of ways to kind of manage that type of thing. But I think it needs to be there. I think it's fair for the broker as well to have that level of protection.
The thing is, as you said, toxic flow sometimes is good for this LB, is bad for that LB. But also sometimes the same LB hating the flow today, tomorrow he will like it. So it's really difficult to manage such things. And sometimes even the size of it, like, I like this size of it. If you put that size of it, then it's toxic for me. I don't want to take it. So I always say you'll never have everyone happy from your clients. Some even if you do the
all
best
of our
them,
clients are happy.
Never.
No, I'm just kidding.
I'm pretty sure, yeah, they are. So I think balancing this with the brokers should be there. Brokers should understand our view of business, and we should understand their view. It is a challenging task, but I think with time, this will be managed with these technologies.
I'm going to let the audience ask a question perhaps a little bit later. We've got a few more minutes. I'm going to ask very briefly to you guys, like, it was almost a question that the organizers asked. Why are you guys here? What do you look for in terms of partnerships here, in terms of clients? Let's say clients come up. What type of clients are you looking for here, from Middle East perhaps? Just briefly, if I can go through. Sam, you want big brokers? What do you need?
I don't think we've got philosophically a target size or necessarily a target profile. As I kind of said before, if you're an LP and if you're a prime of prime, what you really want is diversification in your client base. That's just that might be from a pure market making point of view, but also I think we all want variation in our client base, because that means our businesses are more resilient, and if they're more resilient, then we can offer better services to clients. I think the key thing we always look for and we try and build around our client proposition is we want to have dialogue with clients. It's important that you understand what a client wants and you're honest about what you can provide, what's reasonable, and go from there and work together to a solution. So I think it's dialogue for us is key.
I'm trying to steal their clients.
That makes sense. That's an honest answer.
No, I think it's important to have these relations with other peers companies. It gives us understanding about the market requirements and what the market is going to be. It's help all of us understand what should we give to the clients in our future. I think that's very good to have such conferences always.
Businesses like ours, we were from the very beginning catering to the broker-dealer community, fund managers, small, medium-sized type of businesses, and we've been focused on that ever since. We always welcome business of any type. Nevertheless, we're very pro-business regardless. But the broker-dealers is what we've been very successful with historically. And nowadays, we attract a lot of, prop desks and that sort of thing. It's just the maturity of the business has brought a different breed of clients.
Yeah, I probably agree with John. That's the same target market that we're looking for as well. But for me, these events are a great chance to listen. I think there's only in each event maybe there's a 5 to 10% of new faces that you can see. The rest is we always kind of see each other, but it's a good thing because you need that face time with your existing relationship with your existing partners. You need that face time. And it creates that camaraderie. It kind of builds that, and you go out for lunches and dinners afterwards as well. So for me, it's about having that face time as much as we can. But yeah.
So I'm gonna see if we can ask some questions. Speaking of 5 to 10%, I think I saw Mush here. 5 to 10% of the audience in this crowd has reported to him over the years, I would say. So any questions? Maybe Mush? Any questions from the audience? Maybe can we get a microphone? We got one here. One for Mush as well. We got two.
Hey, sorry.
He doesn't want to speak, Hormuz, though.
So I got a question for all of you, basically, if somebody can answer me. As a liquidity provider, how do you mitigate your risks when the market is currently changing a lot? So when we have a volatile market, it creates a lot of pressures on brokerage, on liquidity providers. So what kind of strategies do you guys implement to mitigate such risks?
Sam, you stop pricing?
Well,
stop the prices when it happens?
Candidly, when things get really volatile, that's kind of when we make our most money.
Yeah.
That's with the big assumption that flow happens at the same time. I think the automatic mechanism for that is spreads, and the reason why that's the primary route is that's how you charge for cost of risk in pretty much any security. So that's the first one. We've kind of touched on before, ensuring that you're not seeing any nefarious flow and making sure that the LPs themselves are making sure they're having that dialogue with their end clients and the prime of primes with their clients and spotting stuff that's slipping through the net. And if you're seeing, as we saw probably post the invasion, when we started to see all flow started to get worse, we just need to have those dialogues up. But it's always going to be about spread for me, I think. That's always going to be the first route.
Yeah, as Sam said, you make most of your money on volatile times, but also as a company, you need to before any volatility. For the whole year, it's at the end of the day, it's a balance sheet play. So you plan and you make sure that you don't stretch yourself way too much. So you have your stress test all year long. When the volatility comes, you will go to these max stress levels, but you've already calculated that. But these are the times that you make your money.
See, they all widen their spreads when the market's volatile. We just keep them really tight. No, but it makes sense. John?
It's risk management. At the end of the day, that's what it comes down to. Assess risk. What is your risk tolerance? What is your risk planning? Be well capitalized. Don't make a sudden move in the last minute. It's all about planning, really. You know your client base. You can do your stress test. It should give you a pretty decent understanding of where you are at any given moment. We have a treasury team, so they do that all day long type thing. Now we are even automating processes to be more efficient.
Okay. Should we, anything to add, or shall I ask?
I just want to say, this year, actually, the whole year was volatile. So volatile is not and something weird to us now. We are living in it every day. So I think we know how to manage it already.
Yeah, makes sense. So Mush, legendary Mush.
Thormos, very kind. Mush Thomas and Advanced Markets.
A bit closer, Mush.
Sorry. Well, I guess the usual practice by this industry, by prime of primes, retail brokers, when it comes to leverage, has been to use it mostly as a marketing tool, really, rather than credit, counterparty risk, credit risk, cost of capital, and things like that. To make an analogy, you guys spoke about kind of negative market events, increasing spreads for a period of time, and then everything kind of goes down. Do you think this gold move and kind of what we just experienced and the increase of cost of capital, is this a temporary blip, or are we going to go back to, whatever leverage to bring you in, and then, let's see what happens?
Yeah, that's interesting because leverage really has been lowered in gold, right? And that's could be a trend where we can see 10 years of no more of that 200 times leverage on gold, which maybe we saw 5 years ago, whatever, Yeah, so that's the question essentially, right? Is this, can you guys see a bit more permanent?
Yeah, maybe if I... Hello, Mosh. So I think, I think it actually, with the gold specifically, I think it's going to get actually worse, probably. It's going to depend on the volatility, but it seems like the demand is still there. Gold is going into kind of new records, which will always kind of create more demand. And until somebody else delves into the space and try to fill what Credit Suisse was doing, and I don't see anyone trying to do that, to be honest. Everybody's kind of shying away from stepping into the gold space. I think things going to get worse. Even, there was a spike in December, and after that, we've seen a lot of the prime brokers already starting to kind of increase leverage again, or increase margin again, sorry. So I think it's going to get worse. Hopefully it gets better at some point, but you need a big player to come in that space.
We need a new bank, Credit Suisse, called Debit Suisse. What do you think of that?
Yeah.
It's time.
Yeah. That's what I think.
Hello. I haven't reported to you yet. I'm just kidding. No.
Not yet.
No, I think, guys, when we discuss this topic, it comes down to really how long-term is your vision? We're very conservative. I find us in a position we don't overextend credit. It's not our interest. And at the end of the day, this is what is going to protect the client at a certain moment and ourselves. So it comes down to risk tolerance, of course, in every business. But I think we will see gold margin much higher in the upcoming months, perhaps. It will be repriced, that risk, that premium will come back.
Hello, Mosh, how are you? Well, to be honest, for gold, we already saw how gold reacts for such situations. We saw it 2008, we saw it 2013, and we didn't go back to those numbers. So I believe that yesterday's surprise is today's reality. I agree with Spear that I think for gold, things will get worse. Because I didn't see any year like this year events. We have major changes happening. And gold is always fragile for such events. And it's a safe haven for many people, traders and non-traders. So yeah, I don't think gold will go back to the good days. Now we're going to have some serious situations.
Okay.
Well, actually, Mohammed, on that kind of note, I think one thing we saw last year that might be the canary down the coal mine is usually you don't get a reprice in this stuff until someone blows up. And no one's blown up yet, but NOP use, and therefore if you're using that as a proxy for a probability for somebody to go belly up, that reached some highs and was very broad last year in gold. That wasn't when we were looking at our NOP consumption across our client base, we didn't have one or two that were a bit of a concern. There was a general increase in consumption, which was kind of alarming. And I think one of the other factors that will probably keep leverage there until something does happen like that is the cost of capital, as you rightly said. when interest rates were zero, the cost of capital was de minimis, right? So it was very easy to place funds at a prime or prime, or someone's offering you prime services, and not be too fussed about it. But now there's a material cost for a lot of brokerages every year. So an easy way to solve that, certainly in the near term, is to increase leverage and take that money off the table. But I think that's, to your point, that's a concerning development.
If I may just add one more thing on it, because I think gold is, it's relevant because it just happened, but it's also the carry trade. I mean, pre-2008, this was the difficult thing to manage when it comes to leverage and things like that. And many brokers weren't around, pre-2008. Many dealers weren't around pre-2008 in this industry. And I think the reason it was difficult with gold is concentration risk. Everybody's either up or down. And the carry trade has similar characteristic. It's on majors, but it's a lot of people lumping up either long or short, depending what the relevancy is. And it seems that we're moving in that direction as well this year.
I think so. The carry trade will be back. I think we're out of time. We're going to discuss carry trade with Mush down there on the floor.
We have an extra chair for you if you...
Thank you. Thanks, guys. We're done.
Thanks, everyone.